Do you know about closing options? With it, I can lock in profits with this covered call option strategy. I can get profits of 80%, 90%, or more. So be sure to watch this video in its entirety because I'm going to share with you not only what I did, but how I did it. And I don't think you're going to want to miss anything of this covered call option strategy. I use covered calls every week to generate an income. Get my free course where I show how I generated an income using covered calls. Just visit my website, coveredcallincomegeneration.com. There are two ways that I can make a profit from selling a covered call. First, if the stock price goes up, I can capture a huge profit just from stock price appreciation. The other way for me to profit is if I think the price of the stock is going down, in which case I can use the covered call to capture a premium payment. So here's a covered call option strategy that I use when I think the price of the stock is going down. It may seem a little bit counterintuitive for me to sell a call option when I think that the price of a stock is going down, but stick with me and watch this video to the end so that I can explain how I'm able to make an income. Before I sell a covered call, I need to own or have direct control of at least 100 shares of the underlying stock for the option contract. Since I'll be using those shares as collateral for the option, they're tagged as reserved and unavailable for me to use for any other transaction for the duration of the option contract. Now, when I actually sell the covered call to a buyer, the option contract gets filled and I immediately receive funds for the purchase of that contract. The money that I received is called the premium. Let's take a look at a real example where I sold a covered call. Activating my trading app, I'm selling a covered call for symbol OCGN, so I press trade, and then trade options, and then I choose the September 17th expiration date, which would give this option contract a duration of 4 days. I'm selecting the $8.50 strike price based on current market conditions and the charts, which at the current time is paying 25 cents per share. So I submit my order, I specify one contract, and for my limit price, I'm going to specify 27 cents because I want to receive 27 cents per share in premium. So reviewing my order, I agree to sell 100 shares of symbol OCGN at $8.50 per share on or before September 17th. And I'm using my 100 shares of OCGN as my collateral. And for selling this covered call option contract, I'll receive $27 as my premium. I submit my order, it gets received and placed in the open marketplace and made available for an interested buyer. A short while later, my order gets filled when a buyer purchases my option contract. Next, let's jump forward to the expiration date to see what I did. Here's a daily chart, and I'm going to focus on the expiration date, September 17th of 2021. And just as a quick reminder, the strike price for my covered call was $8.50. On this day, the stock closed at $7.93 per share, which is 57 cents below my strike price. So if I had let this option contract run to expiration, the option would have finished out of the money, and the contract would have expired worthless. During the morning hours of the expiration day, I didn't have a good sense of what the market price might close at, and I felt it could have finished above my strike price, and as a result, my shares would have been assigned to the buyer. Now, I wasn't too enthusiastic about having my shares assigned at that time, so I decided to use a buy-to-close technique to close out the option contract that I sold, which would release my shares that were reserved as collateral, and also remove my obligation to sell my shares. If you're not familiar with the buy-to-close technique, be sure to check out my other videos which explain what it is and how it works. I'll leave a link in the description below. So with the buy to close, I get to keep my shares and no longer have an obligation to sell them. That's great. How do I do it? It's pretty straightforward. I just submit an order to buy back my option contract. Let me show you how I did it. From the app on my smartphone, here is the covered call option I sold, and you can see that the market price is 3 cents. And the price when I originally sold it, I received 27 cents per share as premium. So in order for me to close this option contract, I'm going to need to purchase it at the current market price. And here's how I did it. I pushed trade, and then buy, and I specify one contract. And for the limit price, I specify 2 cents because I only want to pay 2 cents per share in premium for this contract. And then reviewing my order, I'm agreeing to pay $2 to buy back one open option contract, that's the one I sold, which is going to release my collateral and remove my obligation to sell 100 shares of symbol OCGN for $8.50 on or before September 17th. Looks good, so I submit my order, it gets received and placed in the marketplace for a seller that agrees to my terms for buying this option contract. I opened up my account history and I pulled out this transaction for the buy to close confirmation for stock symbol OCGN. I submitted this buy to close order on September 17th, and it was filled that morning at 10:39 a.m. Pacific time when a seller allowed me to purchase the open call option. Now, when I purchased the call option, I paid 2 cents per share, so I paid a total of $2 to close the option contract, which released my reserved shares from being collateral and also removed my obligation to sell them. Now let's take a look at the transactions where I sold a covered call, and then I closed out the option using a buy to close technique. At the end, we'll wrap it up and find out whether it was profitable or a loss for me. I created a small worksheet so that I can input all the numbers related to the different transactions for this option trade. It'll also be easier for you to follow along as I walk through the worksheet and describe the various components. Let's start by taking a look at the first transaction that started this trade. So here's where I sold a covered call option contract. It started on September 13th for symbol OCGN, where I sold the covered call that had an expiration date of 9/17 of 2021. That gave the length of this option contract 4 days. Now I used the strike price of $8.50, and when I sold this covered call, I received 27 cents per share in premium. So the premium payment that I received was $27. Next, I shared how I was monitoring the market price and decided to use a buy to close technique to close the option contract. Now, I wanted to close the option contract because I wasn't sure if the market price might rise above the strike price later in the day and then force me to sell my shares to the buyer if they got assigned. Let's take a look at the transaction where I executed the buy to close. So on September 17th, I executed a buy to close for the covered call option contract that I had sold that had the expiration date of September 17th, and the strike price was $8.50. Now, to buy back this option contract and execute this buy to close, I paid 2 cents per share as the premium. And so when a seller allowed me to buy this option contract back, I paid a total of $2. So at the conclusion of this specific transaction, the option contract was closed, my shares that were reserved as collateral were released back to me, and my obligation to sell my shares was removed. Now let's look at my total net profit or loss for all of these transactions. So for the original sale of the covered call, I received $27. And then to use the buy to close of that covered call, I had to pay $2. So my net profit was $25. And I still maintain ownership of my 100 shares of OCGN stock, which means I could turn around and sell another covered call and repeat this same transaction over and over again. So I could have let the covered call option run to expiration, and if it had finished out of the money, I would have been able to keep the entire $27 premium. But I wasn't so sure, so instead I opted to buy the close and lock in the $25 gain, which is not 80% of the premium profit, not 90% of the premium profit, but actually 92.5% of the premium. If you like the information about my stock picks, then consider joining my Patreon, where I share exclusive videos of my stock picks every week that I'm going to be using for profitable trades. I also include my research notes, stock analysis, and trading strategies for every stock I pick to watch for that week. And of course, all my videos posted on my Patreon are ad-free. There's one last thing before I end this video. Now, making profits and generating an income from option trading is a great thing, but keep in mind that all gains made from trading are considered income and are subject to applicable tax considerations. So every month, I save a portion of the profits that I earned in order to pay for my federal and state taxes. So please consult with your CPA, licensed financial advisor, and or tax preparer regarding the tax liabilities for your unique situation. If you're still watching this video, I just want to say thank you so much. I really appreciate it. And I also want to wish you good luck and lots of success with all of your trades.